Hey, hard forkers, welcome to the long form conversation with one of the projects that we're assessing in the 1BTC and 32 Ethereum show. If you haven't seen that show yet, there's a link below. Make sure you check it out. Effectively, it's a competition show amongst our team to see who can trade their way to that mark of 1BTC or 32 Ethereum. These projects have made a small donation to us. We then individually decide whether we hold that project, sell it, or invest more. So look, check out the main show and enjoy this long form interview with this project. Cheers.
So yeah, this is the Defi Money Market website. As you can see, the first thing that we showcase when you actually get on here is the fact that we offer 6.25% interest on a couple main assets. We're actually in the process of voting on adding USDT support or Tether support as well to be added onto this list of 3 assets. But the main thing that we're trying to offer with our ecosystem is a stable, uncorrelated yield to on-chain cryptocurrency deposits or cryptocurrency holders. Not to be confused with other services that offer interest as well, like BlockFi, that are larger centralized services where you have to actually open up accounts in these platforms and do things of that nature in order to be able to open up your savings account that earns the interest. We operate more so as a protocol, which means that we're operating very, very strictly on the Ethereum blockchain using smart contracts in order to dictate how we work. And I'm sure that there's going to be a lot of questions that stem from this and happy to dive into them as you kind of guide the conversation along.
Sure.
But the big thing that we're actually working on is designing the actual nuts and bolts, or essentially Lego building blocks of how you can earn interest using real world assets in a crypto environment. And we call this process tokenizing these real world assets, essentially offering the yield out that way. And then we're building it in such a way where we actually can allow other applications to build on top of us in order to be able to get access to the interest. So what we're expecting is kind of like what we've seen with Compound, is seeing other companies build on top of us in order to be able to offer the interest that we're offering through the protocol to their own end customers. And so we kind of see ourselves as like the bottom base layer, kind of offering this as a financial primitive for other individuals that want to build companies on top of this. A good example of this when it comes to Compound is if people are familiar with Dharma, that's spelled Dharma. Dharma is a company that actually built an application on top of Compound offering interest, and their business model is to actually take a little bit of interest off the top. So if Compound offers 5%, for example, at that moment in time, they'll offer 4% to the users and take 1% for themselves. Just as an example, those numbers are not meant to actually be what they actually do, but just more so an example of it per se. So with that, what we actually do is we back the interest in our protocol by real world assets, as I alluded to earlier. These real world assets are income generating. They are over collateralized, and we try to do our best. And what we do right now is really our first step forward with it, but we're trying to make the process as transparent as possible. If you compare something like the interest being generated by something like a bank, you really don't necessarily have a lot of visibility into what they're doing with it, unfortunately. And this could lead to problems whenever there is a larger liquidation that occurs or some catastrophic issues at the bank. People are usually left in the dark about it until they find out after the fact that money was lost, or potentially your own money was lost at the bank when bad things can happen. So for us, we're trying to create this as an alternative savings account for individuals that want to move away from a banking system, or looking for returns that are significantly greater than that of a bank. And in doing so, it can get something that is a best-in-class replacement in our opinion. So with that, what we're trying to do is create what we consider to be a global reserve index of interest-producing or income-generating assets. And so what that looks like is, generally speaking, borrowing or renting against an asset. And our first use case for this was cars. And I think that doesn't get into too much on the homepage, unfortunately, so I'm going to avoid that for right now. But essentially, what we do with the vehicles, for example, is if you own your vehicle outright, you're actually able to take out a loan against it, and if you do not pay back the loan, then we have a loan servicer that is able to repossess the vehicle and recover the principal then plus the interest. So with that, it's not to be confused with doing something like subprime lending, which is you lend money in order for someone to be able to buy or otherwise finance the asset and get a hold of it. Rather, instead, it's they own the asset outright, and they're borrowing against it in case the loan doesn't go well and they have to give the asset back to us. And aside from the things that you see on here, one more thing that is quite that is one of our core pillars of this ecosystem is, in case something does go wrong, one of our core things we need to have is something called a first lien senior secured position against the asset, which essentially means if anything goes wrong, we're the first ones in line that's able to repossess it in case there is that problem. So you can't lend out that same asset to multiple parties then, essentially.
Mhm.
But essentially the way that the system works in just 4 easy steps is you would deposit your tokens into our smart contract system, which spits out an M variant of those tokens. So if you give us DAI, we'll give you M DAI. If you give us USDC, we give M USDC. And these M tokens are a claim on the principal that you deposited into there plus the interest, meaning the exchange rate between M token and the underlying token, the corresponding one, is always going up by whatever the interest rate is. And then behind the scenes, the deposited tokens are used to acquire real world assets that are income producing. The assets pay out interest. And then at any point in time, you can swap those M tokens back to the original ones for your principal plus the interest.
Okay.
So that's the main quirks of how the ecosystem itself works. I mentioned a bit about how our business model works with community integrations and building unique applications on top of us. And then we have some other technical information about how the actual tokens themselves work. So I'll leave that for right now as far as going through the landing page is concerned and open it up to more discussion.
Sure. Stefano, do you want to jump in? Do you want to just take off screen share there?
Sure. So I have an insane amount of questions.
Hopefully I have an insane amount of answers.
Let's see. I'm gonna try to be like as quick as possible. So the loan that like you like the asset per se, who owns that at the moment?
So the way it works is the person who owns the asset who put it up is still the owner of it. What we are
Okay.
technically doing, and right now it's the foundation, but we're in the process of doing the real world legalities of passing this off to the DAO, is what the DAO will essentially own is the liens, or which is essentially owning the contractual rights to the asset in case the loan has a problem with it. So it's kind of like one step removed from owning it.
Yeah. And because like you mentioned, like in the case like that things go south. Did you have like any real case of things like of a specific like asset like not being repaid and so on, or that is like still in theory at the moment?
No, it's not in theory. So the big difference with our organization in comparison to other ones that would be doing something similar is this is a transition from a real functioning business that's been up and running for 5 years, or actually over 5 years now at this point, that we're bringing to more of a crypto-based model. So the other co-founders of the project, Greg and Derek, have a vast amount of experience in traditional finance and actually running businesses that do this. And part of the reasons why we actually did vehicles as our first use case is because they have heavy ties into a company that does this kind of lending. It's called a car equity line of credit. And they actually helped seed the ecosystem with about 8.6 or $8.7 million worth of assets in order to kick it off. And with that, it's gone through the entire process of actually going through and repossessing vehicles and being able to recover capital accordingly. And there's been some very interesting things with it. So as of right now, for the past 5+ years, about 3% or so actually go to repossession. And all the information and statistics I'm going to be telling you here actually are covered in our white paper. With that, the geographic location that the repossession occurs in actually dictates as well what the value of the vehicle is. We're currently running it, I think it's about 8 or 9 states, although I could be wrong. I'm pretty fuzzy on that number. And the reason why we do it this way in the states that we do offer it is because we do it through all electronically through the DMV and otherwise through the government. So we have a very digital process in place whereby individuals actually go through the proven ability to repay and income verification, credit scoring, all that stuff. And then if they pass through our scoring stuff, they actually take pictures of the vehicle and go through the digital process. We're actually able to take the lien out electronically through the government, completely automated. So it lowers our cost of capital down significantly. And the way that people actually use this financial instrument and financial instruments that we're looking into is kind of like short-term revolving lines of credit. So we have contractual engagements that extend out 12 to 18 months. And those contractual engagements are able to help us dictate what the stable interest rate would be. So the reason why we say that our interest rate is stable is because we have these contractual engagements that are locked in for a pretty long period of time. So we can predict out very easily for 12 months what our rates should be. And then essentially as 9 months or 12 months we move forward, if things change, we can, of course, let our users know accordingly, but at least we're letting people know. If we're comparing our rates to the larger DeFi space has interest rates that change literally every 15 seconds as a new block gets mined. And it's all based upon very, very arduous and mathematically based functions that change as supply and demand changes accordingly. So that makes us quite different, especially when you consider the fact that we're trying to operate and run this as a protocol.
Got it. Moving on, like the user part on that. The first one is probably like an easy one, but just like to be clear about that. If for whatever reason, like someone decide to like lend or basically like deposit the funds, is there like any sort of like locked up for like a specific amount of time? Could be like a week, a month, 6 months or so on, or they can withdraw like at any specific time basically?
They can withdraw at any time, actually. There's no lockups. The way the protocol works is when you deposit your funds into there, there's currently no restrictions on being able to withdraw from there from any point in time moving forward.
How about like on the, because I'm one thing that like I want to get to like that question on like you're probably familiar with the platform like Real.co, where basically like there you have like the real estate tokenization and you're getting like your interest from there and et cetera, et cetera. In your specific case, like when the user sign ups, is it like on the pure DeFi side on being like so Compound or Maker and so on, where you just like connect your wallet and nothing else, or nothing else? Like there is no contract
Correct.
signs or nothing like that.
Nothing. Yeah, operating very purely as a protocol. A lot of our design influence was from Compound and how they designed their C tokens, which for those who do not know, C tokens are the interest earning tokens in the Compound ecosystem, which are equivalent to our M tokens. Heavily influenced in there. And if you really think about it, our two protocols are very similar in how they're designed and how you interact with them. The main difference, though, is just how we generate the interest and then the implications of how stable the interest rate can be because of how we generate it. And of course, there's other things that become nuanced differences from there and things of that nature because we do have a real world component. But if you break it down to its most basic form, for those that are familiar with Compound, it works quite similarly.
Okay. That answer everything from my side. Don't have anything else at the moment.
You said you had 1 million questions. It turned out to be 2. So, Corey, you obviously answered well.
Yeah, no, it connects
So
like
far,
the dots, like for sure, absolutely.
Sure.
but with that, there are some interesting quirks with the ecosystem. Like the fact that we do have this real world component means that we do take some of the underlying funds that are being deposited into there, and we do convert it into fiat, so we can allocate it to an asset to be able to produce the interest. Of course, that's an essential component. So with that, for example, if we have $100 million in our ecosystem, for example, that might mean that we only have $50 million in crypto-based deposits for liquidity's sake. So there is potential for there to be like this so-called run on the bank. But part of the reason why we designed the protocol in this way, whereas if someone or if the users decided to band together and they wanted to withdraw every dollar at that moment in time, what would happen is there would be a $50 million deficit in that case. And that's more of a temporary one if you compare us to like a regular bank because of 2 reasons. The first is as capital becomes unlocked from the assets, it'll obligate us to move funds back into this on-chain environment to replenish liquidity. And part of the reason why we designed it to be a protocol in this way is whenever there is a liquidity deficit such that I just described, it actually places restrictions on the administrators of the protocol to not be able to take or make certain actions as a responsibility measure. And right now, since we just launched our governance dashboard with our governance token, which will be a separate conversation, I'm sure, with this, Um, that means that the DAO itself will be restricted in what it can and can't do when there's liquidity restrictions like that. But getting back to why we designed the protocol in this way, because everything is designed as a token with our M tokens like this, that means that we can stand up secondary market trading for people to trade between M tokens and regular tokens. And this is what we consider to be secondary market trading then. If you look at taking the M tokens and walking them over to our smart contracts and redeeming it at the true exchange rate for the underlying thing. So in this case, let's say you have 100 M DAI. Over the course of a year, it turns into 106.25 DAI. You walk it over, that would be the primary market then, and you'd be getting the primary exchange rate for it. In the event of a liquidity deficit, we're anticipating and also trying to groom the ecosystem in this way where we actually have trading set up for this. So people that desperately need to get access to liquidity to get access to their underlying assets can trade back into it. And that'd probably come at a slight premium to whatever the true exchange rate is for people that want to take the hit by exchanging back into it earlier.
Right. So tell us about the DMM or DMG, the governance
DMG.
token.
Yeah. So with that, because of the way that we designed the protocol, it's all smart contract based, meaning that there's very tightly configurable parameters. We actually set it up so we can pass off control of it from our foundation to a DAO, or a decentralized autonomous organization. It's a pretty hot topic right now in the DeFi space because it essentially allows anyone that owns our DMG governance token to essentially voice their opinion and be able to direct the direction of the protocol then. So with that, we actually just handed off control of it officially this past week. We launched our governance dashboard, and people have been utilizing it in order to be able to move the direction of the protocol forward. So right now we have our first actual vote taking place, which is the onboarding of USDT or Tether into the ecosystem as another interest earning asset. Pretty soon we're going to be voting on onboarding a new real world asset to back our interest, which is actually going to be 2 PC-12 private aircraft. Going to be quite interesting, but overall we're really trying to move it in the direction of grooming the ecosystem to, like I said, create that global reserve index of assets that's revenue producing from around the world. By implication, then, if you are an investor from almost anywhere in the world, to be able to invest in these things from anywhere and get diversification that you would not be able to get access to otherwise. But with that, though, like I said, we see the DMG governance token as kind of like this binding agent, or like this glue that keeps our ecosystem tightly woven together, because it's able to help us align incentives to be able to give people weight in their vote based upon the amount of risks they're taking from how much they're able to participate and put their economic stake into the ecosystem, as well as be able to bring on people that have different roles that are responsible for different things. So if we can kind of compare our DAO to other ones, the main difference I would say is with something like Maker, for example, or Compound, the role of every DAO participant is essentially the same, that they're voting on moving the ecosystem forward, and their weight might be different, but overall their role is pretty much the same. But with ours, we have some pretty tightly defined different ones. And what I'm alluding to is something that, if people have read our white paper, let's see this thing called principals and affiliates. And principals and affiliates are essentially what we would consider to be like these real world bridges that are responsible for the onboarding of these new assets. So for right now, we're essentially helping with bringing on these 2 aircraft, courtesy of another firm though, but we're kind of helping them walk through the process and hand holding them through it. But eventually we see these principals and affiliates being the ones responsible for it. And if you kind of look at the traditional financial world, it's most closely similar to something that Greg had experience with over at his time being a CEO between a joint venture between MasterCard and Telefonica, where essentially some people get elevated status in order to take on extra responsibility. But with that, they also get some extra reward for doing so. And a DAO can actually help with governing these individuals and essentially boot them out if they aren't doing their job responsibly. So there's a lot of things that are there with it, but it's a very delicate process because of a number of reasons, but also because we have this real world aspect of it. It's quite delicate by nature because we need to make sure that things are being done right, and we need to have the right escape hatches in case they aren't.
Sure. So, I mean, on that note, having exposure to the success of the company that's done by getting the DMG token. Is that correct?
Correct.
And what's sort of the legal status of that for the you know what you know, somebody new to the space? How would you describe what they're actually purchasing there?
Yeah, so the DMG governance token itself, what they're purchasing into is a utility token that allows them to participate in this ecosystem, in the governance of it, as well as the onboarding of new things into there in order to produce interest. Is essentially what it is. And like I said, the difference between us and other protocols is how we generate that interest. To those individuals that think that we operate, the token is more closely resembles that of a security because of the way that we generate the interest. The biggest thing I would say in response to that is the way that you generate interest is not what dictates you being a security or not. Rather, there's a lot of other things that go into the classification of it. But yeah, so like that's really the main thing. It's a very simple protocol by nature, but the implications for it are very large. It's not like the most exciting thing in the world, but we think it's very, very neat because we're combining some very different things that haven't been configured in this way before in order to do something very different.
Sure. Okay. And how long has when did this launch? You've been around for, what is it, two or 3 months with the launch of that?
So we launched the DMG governance token in June. We launched the protocol itself in March, and we've been otherwise working on this in a more formal way since about November or so.
Okay.
We kind of came out of the woodwork coming closer to March, and we've really been operating under the mindset of putting our work and our best foot forward first, doing it that way. Essentially, the idea being we don't really like to operate on hype or making announcements of our announcements. We really want to just be able to, put our, roll our sleeves up and just get things done.
Okay, fantastic. Stefano, any questions before we have a look at Dolomite?
Yeah, you mentioned that like you're gonna like add on the aircraft part. So and from the website you obviously have like the car, the boats, and the plane. So I assume that it's gonna be like transportation as like in general on phase one. As the project is like relatively new on that side, what's next? Like what's gonna be like on 24-month, 36-month on that? Like where is the model going to be like stretch? Where is like the sky is going to be the point on that?
So the main thing I would say is, aside from the asset front, which is of course we're going to be looking to do multiple use cases or test cases across different assets. Our main goal for right now is to give people a taste for what this could look like. We had two options beforehand, or no, probably more than two, but if I broke it down, it's really just two. We said we could expand on our car use case and get more assets under there so we can increase our AUM, or we can look at a new asset. We decided the best way to go about it was to get a new asset because we didn't want to become known as the car company that, or the DeFi car company that is bringing in money that way. We really wanted to give people a taste for the fact that this really is going to be, like I said, the global reserve for assets. And so private aircraft has become quite hot, especially with COVID. A lot of people confuse this with public aircraft transportation, which has been suffering quite a bit. But because of people's hesitancy to travel using public transportation, private aircraft has become quite popular for those that are in more of the affluent, that are more affluent. So we see it as a pretty lucrative opportunity in such a way that it works. So we'll have more information about that as we get closer to that, and we'll be putting more information on that on essentially a DAO talk like website for discussion forum that's slow moving and methodical for people to ask their questions, read more about it, and otherwise gather information from our ever increasing paper trail. But with that, yeah, we're definitely looking to expand beyond these couple assets that you see right here. There'll be some real estate test cases, probably some aquatic vehicles as well, but really just looking for assets that have some nice hardy value to them that don't fluctuate much, especially over their contractual term, that are able to produce very steady returns. And so with that, we think that we'll probably end up expanding more and more into these different use cases over time so that as we accrue these test cases, and we feel happy that we've built up a sufficient number of them, then we'll say, okay, let's really blow up the car segment, or we see an opportunity in the plane one. And essentially either ourselves or these principals and affiliates, which will be the other part of this 24-month timeline, we'll be able to bring more and more deal flow to the DAO then. And so with that, the big thing over the 24-month period is also trying to broker these deals and get more people involved so that us as a foundation can become a bit more hands-off to really make this into an immovable, an unstoppable force rather, where anyone is able to participate in it because it's permissionless, and all these different entities are able to come together to be able to participate in it essentially, from any jurisdiction.
Could you put a
Be able to
little
add
more
value.
context around that for us? I mean, people watching this, I know a lot of people in the aircraft space, especially in the private jet space. So how would they, who would they contact? How would they get involved if they wanted to utilize this protocol?
So the way that they would get involved definitely changes depending on like where we're at in this timeline. So for right now, like one of the most natural things would be like reaching out to us as a foundation to be able to kick the process off and start moving this forward actually, and see what kind of merit there is to a deal we can put into place and if it matches our criteria. If we're talking about 12 or 24 months from now, as we move to become more of a decentralized entity, the foundation itself would also have less power and less voting weight because the protocol's voting power would also be more widely distributed. And so with that, we'll have more public-facing forums for them to actually post proposals for this. I would imagine there'll probably be some individuals that they can probably talk to first to get some signaling on whether it would be worth posting the proposal, or what kind of verbiage or language should I use to get the best results, so people are more receptive to it, and things of that nature. But eventually, all avenues will point towards it being voted in. Even at this juncture right now, it had to get voted in by the members of the DAO.
Yep. Okay. Fantastic.
So sorry, let me see if I understood correctly. Let's say that I have like I don't know, a private jet, and I want to like put that as a collateral on the platform. At that point, the process to like approve that or deny it in the future, because right now is in the foundation, but like in the future is gonna be also by the DAO, that decision. Is that correct?
Essentially, at some point, the DAO would have to vote it in or not. I'm sure that eventually there'll have to be like some level of human contact with this, where some prominent members of the DAO would probably come in and step in to help coordinate and work through the deal flow for it. But eventually there would have to be the aspect of it getting voted in and added in as an asset in order to be able to capitalize on the line of credit for it, and also be able to offer the interest then to the community.
I mean, totally naive on the sector, but isn't like something like that gonna increase like the time required to actually like tokenize the asset at that point, and to also increase risk on the fact that tons of people that are buying projects have no idea on like what are the checklist of or the good and bad side of something like that.
Absolutely. And this is where it becomes quite specialized, because there'll be some prominent members of the DAO that maybe are much stronger software engineers that can help build stuff for this sort of thing, but don't necessarily know how to navigate a deal to know what's good and what isn't. And that's actually where the principals and affiliates that I was mentioning beforehand come into play, because they'd be, essentially operating as the quote unquote investment bank responsible for working through and navigating through the deal to be able to first filter it or work through the problems they might see there before even presenting it to the DAO. That's actually what their primary responsibility would be.
I don't know. I'm seeing that like as a lot of like possible bad situations happening. I'm thinking about like if I'm a normal person that goes like on what is happening now on the airdrops of Compound, for example. I just put like an insane amount of token just like to receive the airdrops. I join a DAO. To me, like as a simple like money making point of view, is like whatever new things comes in is like yeah, it's more money, it's bigger return. Just like say yes to everything. Plus mentally and psychologically, I'm like, oh, there is also that banker that did like the initial check. He knows I know nothing. I'm just saying yes to everything. I don't know. Is
Well,
there
that's why
like
there's
any...
also Well, that's why also like you have this quite democratic process in place for voting things in. Even if the principal slash affiliate decides that it's good, it's good, it's good, and just check it all off, there ultimately has to be these checks and balances in place, which is why it eventually has to go to this vote. And if the principal or affiliate isn't acting responsibly and the DAO sees this, the DAO would be able to vote the principal slash affiliate out of their position then. And they would actually have to stake DMG in order to be able to get into that position in the first place. So they would have some skin in the game, such that if they did start to pose more risk to the ecosystem or weren't doing their job responsibility, they could have their stakes slashed. So these are things that I'm mentioning right now that are very much so still in the in the idea slash development stage, depending on which part we're looking at. So it's most certainly not set in stone. But these are why we have these certain things in place and these escape hatches slash levers that I was alluding to earlier in order to be able to address them. And presumably also like the individuals that you're talking about before, this persona of people coming in because they see opportunities right now and to make good returns. Those aren't going to be necessarily the individuals that have the most stake in the ecosystem to be the ones like that are actually like making these decisions or playing a very large part in helping make these decisions. Like you'll always have people that are going to be in and out, and you'll have people that are really firmly cementing their feet in the ground with the ecosystem then as well.
Fair enough. Yeah.
Could you tell us a little more about that ecosystem, the founders, and how it's structured?
Sure thing. So as for myself, I first entered the crypto space in 2015, and Adam Nucky, who's my co-founder with Dolomite, he entered in 2013. As for myself, this came in actually needing to use Bitcoin as a use case, and then turned into working on bug bounties and open source development bounties and things of that nature. But the story with it actually was working on modding some video games at the time, and PayPal unfortunately shut down this individual's company because they didn't like the ethics behind game modding software, and then was forced to use Bitcoin to pay for it. And I guess, as I say, the rest was history. Kind of blew my mind the first time I used it, and was extremely excited by the implications and the possibilities of it. As for the other co-founders, Adam actually first came in 2013 developing open source miners in Python. That was actually after Bitcoin had spiked to $1,000 for the first time. So a lot of people were building new chains, trying to experiment building new things. And for him, it was a careful experimentation process that he thought was a lot of fun and was more so on the tech side of it.
Yep.
The other two co-founders, Greg and Derek, have a lot of years of experience in traditional finance, both early age internet entrepreneurs, and Greg in particular has been the CEO as well between a joint venture between MasterCard and Telefonica. He's a former CIA agent, very, very well decorated background, and has built a lot of quite tremendous companies. Actually built one of the first real estate portals for real estate asset securitization, and actually sell that off to Citigroup. So it's one of those things where honestly, it's like if you look at his LinkedIn, look at his background, and really both their backgrounds rather, it's one of those things where it lists off more things that even I can remember, honestly. Derek as well, and one of his more notable things that he was chief legal at either Citi or MasterCard. Honestly, I don't recall. I'm kind of fuzzy in the details because there's so many things flying around right now. But very, very, very strong backgrounds. And when he kind of combined the networking, deal flow, as well as experience with running companies, and then with Derek, especially with the legal side, and you kind of marry this with the technological piece that we're working on the crypto slash DeFi side, it really rounds us out quite nicely to be able to execute pretty well on our vision from what we've seen so far, and we'll be able to get done.
Okay, fantastic, excellent. Well, I think we've covered DeFi Money Market pretty well there. Let's have a look at Dolomite.